Thinking of investing into REITs for that sweet passive income? With so many REITs to choose from, which REIT should you go for? Oh, I know, let's go for all of them via REIT ETF. That way, you won't buy the wrong REIT if you buy all of them. In this video, we will be going through all the REIT ETFs that are listed in the Singapore Exchange and which is the best one you should go for. As a bonus, I've compiled all this info into this super detailed spreadsheet, which you can download for free, link down below, yeah? Alright, the first REIT ETF on this list is the Lion Philippe S-REIT ETF with the ticker symbol CLR. With an AUM of $539 million, this is the largest REIT ETF here. This REIT tracks the Morningstar Singapore REIT Yield Focus Index, which, as the name suggests, focuses entirely on Singapore-listed REITs. This index uses a rules-based approach to select and rate REITs based on three key factors: quality, financial health, and dividend yield. And to ensure diversification, each holding is capped to a maximum weight of 10%. The ETF currently holds 20 REITs, diversified across several sectors, with industrial being the largest at 38%, followed by retail and office sectors. As for the top 10 holdings, the largest allocation goes to CapitaLand Integrated Commercial Trust at 10.5%, closely followed by CapitaLand Ascendas REIT and Mapletree Pan Asia Commercial Trust, each at 9.8%. This ETF has an expense ratio of 0.6%, which is pretty close to most of the cheaper REIT ETFs in this list. As of making this video, it has a dividend yield of 5.9%. The dividends are distributed semi-annually, and you are able to invest in this ETF via SRS. Quick pause: if you are looking to save on fees when investing in the Singapore market, check out USmart SG. That's because they have recently lowered their fees for the Singapore markets to just 0.03% commission and 0.03% platform fee with no minimum commission, making them one of the cheapest brokers to invest in the Singapore market. But wait, there's more. They also let you invest with zero fees when you set up regular savings plans to invest into eligible Singapore and US stocks and ETFs. To enjoy the zero-cost RSP promo, all you need to do is open up the USmart SG app, go to Trade, More, Regular Savings Plan, then select the stock that you want to invest in. And here, you can start investing with as little as $100. What's nice is that you can even ask USmart SG to automatically debit the funds directly from your bank accounts via eGiro deductions. This lets you skip the hassle of manually transferring in every time. New users who sign up with USmart SG now will receive up to $202 worth of welcome gifts, including share vouchers, cash vouchers, and free US and Singapore markets live pricing when you fulfill the terms and conditions. So sign up to USmart SG now using my link down below to take advantage of this exclusive offer. Let's get back to the video. Next up is the Nikko M Straits Trading Asia ex-Japan REIT ETF, which is also the second largest REIT ETF listed in SGX. There are two versions of this ETF: CFA that's denominated in SGD and COI that's denominated in USD. This ETF tracks the FTSE REITs Index, which focuses on REITs across Asia, excluding Japan. And there's a 10% cap on each constituent to maintain diversification. As to why Japan is left out, it's not because we don't want to be friends with them, but rather, Asia ex-Japan is a common investment strategy. That's because Japan is seen as a highly developed market, while the rest of Asia includes many emerging or developing economies, regions that investors often target for their high growth potential. As for the index methodology, it's relatively straightforward. Constituents are selected based on a free float adjusted market capitalization, with additional size and revenue screens to ensure quality and investability. Looking at the holdings, you will see that a large percentage of the holdings is in Singapore at 69%, followed by Hong Kong at 13%. In terms of sector allocation, retail REITs take up around 33% of the ETF, followed by industrial REITs, then office REITs. As for the top 10 holdings, the top 2 allocation goes to CapitaLand Ascendas REIT and CICT, followed by Link REIT from Hong Kong, then Embassy Office Parks REIT that's from India. This ETF has an expense ratio of 0.55%, a dividend yield of 5.9%, and the dividends are distributed quarterly. This is the only REIT ETF that you can invest in via both CPF and SRS. Moving on, we have the CSOP IHS REIT Leaders Index ETF with the ticker symbol SRT that's in SGD and SRU that's in USD. Like the Lion Philippe S-REIT ETF, this REIT ETF also focuses exclusively on the Singapore-listed REITs. However, the selection and weighting methodology is quite different. While the Lion Philippe ETF uses 3 key factors to determine and weight its holdings, the index of this ETF takes a more straightforward approach. It selects REITs based on basic eligibility criteria such as liquidity, free float, and market capitalization, then weights them based on the market cap. The ETF doesn't provide a detailed breakdown of its sector allocation, but given that its holdings closely mirror those of the CFR ETF, we can also expect a similar sector distribution. Likewise, the top holdings are largely the same, with only slight variations in weightage. This ETF has an expense ratio of 0.6%, a dividend yield of 6.16%. The dividends are distributed semi-annually, and you are able to invest in this ETF via SRS. Next up is the Philippe SGX APAC Dividend Leaders REIT ETF, with the ticker symbol BYJ in SGD and BYI in USD. Among the 5 REIT ETFs we are covering, this one has the smallest assets under management. This ETF tracks the IH APAC ex-Japan Dividend Leaders REIT Index, which focuses on the top 30 REITs across the Asia-Pacific region. The REITs are selected based on the total dividends paid over the past 12 months, size, free float market capitalization, and liquidity. They are then ranked and weighted according to their dividend payouts. The goal of this approach is to enhance risk-adjusted returns compared to traditional market capitalization weighted indexes by placing greater emphasis on income-generating potential rather than just company size. In terms of geographical allocation, almost half of the REITs in the ETF are from Australia, followed by close to 1/3 from Singapore, then 10% from Hong Kong. And since this index ranks its holdings based on total dividends paid instead of the market cap, the top 10 holdings will look a little different from the rest of the REIT ETFs. In this case, Link REIT is at the top, followed by Center Group, which is from Australia, then only CICT. Among all the REIT ETFs on this list, this ETF has the highest expense ratio at 0.95%. It offers a dividend yield of 4.25%. The dividends are distributed semi-annually, and you are able to invest in this ETF via SRS. Lastly, we have the UOB APAC Green REIT ETF with the ticker symbol GRN. This ETF takes a more unique approach. Instead of focusing solely on traditional metrics like market capitalization or dividend yields, it also considers environmental performance when selecting its holdings. The idea behind this strategy is that there is a growing global demand for green infrastructure, which could present attractive long-term opportunities for investors. This ETF has 50 REITs across the Asia-Pacific region. In terms of country allocation, 40% of the holdings are from Australia, followed by 32% from Japan and 20% from Singapore. Sector-wise, the portfolio comprises 35% retail REITs, 30% diversified REITs, and 13% industrial REITs. As for the top 10 holdings, you'll see many familiar names like CapitaLand Integrated Commercial Trust, Stockland Center Group, and Link REIT. The ETF has a relatively high expense ratio of 0.82%, offers a dividend yield of 4.14%, and distributes dividends quarterly. It's also eligible for investment using SRS funds. So then, which REIT ETF should you go for? One of the biggest mistakes an investor can make is choosing an ETF solely based on dividend yield or past performance. That's not a reliable strategy because these are backward-looking metrics, and past returns don't guarantee future results. Instead, I will base my decision on these 4 key criteria. First, expense ratio. A lower expense ratio means less cost eating into your returns. Over time, this can make a significant difference in your overall performance. Second, assets under management. ETFs with higher AUM tends to be more liquid, which allows you to buy and sell more easily with tighter bid-ask spreads. It also often signals strong investor confidence in the fund. Third, the methodology of the index. Not all indices are created equal. That's because the way the index selects the REITs and its holdings will directly affect your exposure to different sectors and risk factors. And lastly, the geographic exposure of the ETF. Some ETFs focus solely on Singapore-listed REITs, while others span across Asia-Pacific. A broader geographic spread can provide greater diversification and reduce reliance on the performance of a single market. So based on this criteria, I would say my personal favorite would be the Nikko M Straits Trading Asia ex-Japan REIT ETF or CFA. Not investment advice and not telling you to buy this ETF of course, just telling you which is my favorite, and here's why. First, it has the lowest expense ratio out of all the ETFs here. This means lower cost and better savings. Second, it has a healthy total net asset value of around $418 million. This translates into better liquidity and tighter bid-ask spreads, making it easier to trade efficiently. Plus, its high AUM also indicates strong investor interest and stability. Third, I like the simplicity of its methodology. No overcomplicated factors or mysterious formulas. It just selects and ranks REITs based on clear, transparent criteria like free float adjustment, liquidity, size, and revenue. And finally, this ETF focuses not just on the Singapore markets alone, but across Asia-Pacific markets, excluding Japan. This allows investors to tap into the growth potential of emerging and developing economies in the region, such as Hong Kong, Australia, and others. This can help to diversify risk while capturing opportunities beyond just Singapore. Plus, you can also invest in this ETF via CPF, which is a huge plus point. That's because you'll get to avoid all the common challenges faced when investing in individual REITs via CPF, such as having to come up with additional funds during rights issues to avoid dilution or meeting minimum lot sizes. So that was a quick comparison between all the Singapore REIT ETFs. Hopefully, this helped you out. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.